the first thing, if you're stepping into any industry, you need to identify who are the market leaders. I started asking myself lots of questions because I've lost a lot. You get to the point where it feels like enough is enough. I started asking questions. I started researching. I said, okay, let me take a step back and process things. I need to see who control this industry, who are the market leaders. When you've done this, the next thing is, how do they operate? The institutions like the banks, the hedge funds, the financial institutions, they are not aiming for 100% in 1 week at all. They are not aiming for 500% in 2 days. What I had to now do is I started going through their data, and I got to find out something remarkable. These guys make approximately, let's make it be 100% annually. 100% annually is averaging around 10% monthly, 10 to 11% monthly. If the market leaders would focus on making 10% every month, why would a retail trader who doesn't even have, a say in the grand scheme of things? Your $100, your $1,000 can't even move the market 1 pip.
Dear traders, the impact of belonging to an active forex trading community cannot be overemphasized. A community where you have access to proper information, chart breakdown, forex trading insight, and materials that will help in improving your forex trading skills. Now, in the description of this video, you will find a link to my free Telegram community. And in this community, you have access to chart breakdowns, weekly market analysis, necessary information and insights to help you improve your forex trading skill. Now, let's dive right in.
All right, ladies and gentlemen, welcome to yet another exciting episode of Forex Trading Straight Talk podcast, and I'm your host, Mr. Peak FX, the fastest growing, in fact, the biggest podcast in Africa and Nigeria, and the fastest growing in the world. And thanks to you for your support, your views, your shares, your contributions, and also thanks to our mentors for coming on board to share valuable information for the community to help people make informed decisions, right? And today I have somebody very amazing, and we're going to be talking about something very, very important that everybody needs in the forex space, both the beginners, the intermediate, and the advanced. Okay, and ladies and gentlemen, without further ado, let me introduce to you one of Nigeria's finest in trading and also finest facially. Ladies and gentlemen, I am Dake Jr. Welcome to the show.
Thank you so much, man, for having me. So really excited to be here. To be honest, I've seen a lot of episodes, and watching them, like, when will this guy invite me?
No, we always reserve, when you have lots of things to consume, you always reserve, the best for the later. First of all, eat all those ones that are tap best. I'm not saying all that, those are bit out over there.
Well, thank you for having me. I'm really excited to be here.
Yeah, welcome. So, first off, I always like it when, traders come here to share their experience, their starting experience in trading, because some of these stories relate a lot to many people that are interested in forex trading or currently going through some stuff. So I just want you to give me a background of your forex trading journey, how you started, and what got you to where you are currently.
Okay, amazing. For me, I'm really not too proud to, talk about when I started, because to be very honest, I started trading, or I knew about trading, in the year 2016, and it took me about 4 to 5 years before I started understanding the whole concept. And for me, then, I think then I was in the university and I wanted some sort of extra source of income. You need something to sustain yourself in school beyond just what your parents are giving you and whatnot. And also, to be honest, my parents never liked the idea of trading. Even going to university, I come from a military background, of course, and my dad had this, predefined path for all of us. Yeah, for him, you need to have something tangible doing, and it was all about NDA. When you graduate, there is a job for you. There's a solid position for you. So, when I introduced the concept that I wanted to go to a normal university, it was really a huge problem. And then when I decided that, okay, this is why I want to study computer engineering, and we started having the conversation back and forth, back and forth, back and forth, and they accepted. And that was the first disappointment, right? Then the second disappointment is
That's for him.
Exactly, for him. So the second disappointment is, so you don't want to pursue the course that made you not to go to NDA. Now you want to become a trader. So this is like disappointment times two. So a lot of people think I had like support when I started trading. They believe that, because of where you're coming from, your parents, there's money, there's this, there's this. But I will be very honest, I was cut off from, financing very early in university, because I've always been one that doesn't listen to people's opinion. You know how they say experience is the best teacher. I want to go, I want to experience, and I want to see myself. So I started trading in 2016. I started learning about trading, and the first mistake I had was, I started learning binary rather than the actual trading itself. And to be honest, if you started trading in 2016, there's a higher tendency that what you would stump into at the beginning stage is binary. I don't want to call brands, but they know themselves. So the thing is, I felt like I was trading. I felt like, oh, you're ready now to start trading. You've studied everything you need to study. And I deposited my tuition fee. This is disappointment number three. So they gave me my tuition fee. I was supposed to, pay. Exams were coming, and I felt, okay, since you've learned this thing, and binary gave me this hope that you could, fund your money now, and in less than 5 minutes you've made about 2x or 1x. They don't do 2x. So I took the school fees, 100% of it deposited into the platform, and in less than 2 minutes, it's always a countdown.
Yeah.
So in less than 2 minutes, I
Call or put.
lost all up to it. Exactly. So it's always call or put, and in less than 2 minutes, I legally lost everything. And that was the moment where it became real to me. I started understanding that, okay, so not all that glitters is gold.
Yeah.
So from 2016, 2017, 2018, it was more about learning. Then I think mid 2018, that was when I got to find out that you've been studying binary. It wasn't FOREX. So I had to start relearning again, restudying again, and I almost wanted to fall into another trap, the IML people. I don't know if
That was
video on Alexa, those guys that started the pyramid thing. So you bring one person, and it wasn't making sense to me. I was like, I want to learn Forex. Why do I have to refer somebody to so
nothing
just
is
be
about
make
level
sense,
market.
right?
It wasn't it
So
for I did it.
so I got into, and I had to like exit. So for me, trading started making sense in during the pandemic period. To be very honest, that was when I started understanding that, okay, this is how it is. I started finding my foot and realizing that, okay, for you to grow as a trader, you need to move your perspective away from certainties. Perfection is not having everything complete. Perfection is building in the process. You are moving. We don't start because we have everything figured out. We by the time we start, we begin to figure things out. So that was when I, in 2020, 2021, I moved my perspective away from, the idea of a strategy. Now I know I'm moving so fast. You actually
Okay.
So the thing is, before the pandemic, I was just like every other trader, right? You are obsessed about strategy. You want to get the best system. If this guy is trading SMC, you're on there learning your SMC. If the other guy is trading Fibonacci, you're on there learning. And for me, it was hopping from one system. I call this the loop, right? The loop is a system where you are going in circles, right? And this is something that I have experienced firsthand. You think you're making progress. There's a thing called activity and productivity, right? You could be having activities, but you're not productive.
Yeah.
So prior before 2020, I was going in a loop where you pick a system, you test it. Maybe you test it for a while. Back testing wasn't so popular back then. Started being so like an everyday language for traders in like 2024, 2023, 2025. So then it was pick a system, you trade it for a while, you make some profit, you're excited, you take some loss, you drop it, you go back to YouTube, you learn another one. So it's like going in that circles, and there's no tangible results. So one time I had to ask myself, what am I missing? Right? What are the things I need to adjust? Why is this not working for me? So in order for me to make a difference, in order for me to, reintroduce a new thought process, I had to shift my perspective, right? And rather than focus or see things from the retail perspective, I started focusing on the industry leaders, right? Institutions. I don't mean SMC guys. Now, I mean the institutions. If you're stepping into any industry for the first time, let's be very honest, right? There's a thing called market research, right? And what you do with market research is you try to understand you need to identify market leaders, industry leaders. If you're stepping into the fashion brand, the first thing you want to do is to identify the market leaders, because you need to know who control this market. So you identifying the bigger brands, and then the next thing is their strengths. How did they gain visibility? What are they doing? And when you read about their success stories or their marketing strategy, you're not studying to copy them, but you're studying to be informed. Right. So, and then you also read about the weakness as well. Now, I'm saying all of this because I'm driving towards somewhere. Now, the average typical retail trader, when we step in, we either start learning from YouTube, right? You are obsessed about this guy's lifestyle. I love that Mr. Peak is traveling all around the world. I want to have this. So rather than try to do a proper research, the first thing, if you're stepping into any industry, you need to identify who are the market leaders. So I started asking myself lots of questions because I've lost a lot, to be honest. I've lost a lot. And I wasn't being financed by parents. I wasn't being financed by anyone. These are personal funds. So, you get to the point where it feels like enough is enough. I've seen enough and I need to re-strategize. So I started asking questions. I started researching. I said, okay, let me take a step back and process things. I need to see who control this industry, who are the market leaders. So I identify the market leaders. When you've done this, the next thing is, how do they operate? How do they think? What's their thought process? How do they target their profits? And that was when it started making sense to me that the institutions like the banks, the hedge funds, the financial institutions, they are not aiming for 100% in 1 week at all. They are not aiming for 500% in 2 days. These guys, as a matter of fact, if you're a trader, you know that financial figures are public, right? If a company is publicly traded, it means that you need to like put your annual report online so people can see. So what I did was, what I had to now do is I started going through their data, the likes of Goldman Sachs or the bigger guys. I don't want to call names, right? So I started going through the data and I got to find out something remarkable. These guys make approximately, let's make it be 100% annually. Okay? Now, 100% annually is averaging around 10% more, 10 to 11% monthly. So that really changed my perspective. I said, okay, if the market leaders would focus on making 10% every month, why would a retail trader who
1%.
doesn't even have, a say in the grand scheme of things, your $100, your $1,000 can't even move the market one peep. So why won't you copy how the industry leaders trade? So for me, that was what changed my perspective. I started now researching about risk management, right? I started trying to understand, okay, the game of probability itself. And that would see, I keep saying this, right? Trading is more of a game of probability than it is about charts and fundamentals.
Yeah.
You see, when you actually do a research on the concept of probability, you would really understand what trading is all about. In a game of probability, for example, in an event where there's a 50-50 scenario, because in this our market, we're either buying or selling. At the end of the day, no matter how sophisticated your system is, you're either buying or selling. So which means if we relate the flip coin, the flipping of coin, it would perfectly illustrate trading, because you can either have heads or tail. So when we focus on this and we try to introduce profitability into the concept, you get to realize that if you're random in the coin flip challenge, if now you pick head, the other time you pick tail, the other time you're head, you wouldn't have a consistent edge. But then by the time you become constant, you stay on heads. Now they keep flipping. There's a higher tendency that at least 20 to 30% that coin would fall on heads, right? So that was what really changed for me, and I understood that. So it's really not the technical analysis. Yes, it's important. You need to know the direction of the market, but that is not the real thing. The real thing, in essence, is being constant with a fixed set of rule, right? You are taking trades and you're very systemic, irrespective of outcome. You lose, you repeat the same thing. You lose or you win, you repeat the same thing over and over and over again. That was what changed a lot for me. So from then, since then I moved my perspective, it was now risk management, right? Risk management, probability. I wouldn't lie to you. I suck at technical analysis, but if I show you my trading history, you can see consistency in terms of progress. I could take 10 losses, but then one win could cover up the losses. And that is what trading is all about. Most traders believe that it's, they need one secret recipe that maybe their mentor does have that they don't have. So yeah, in summary, for me, it's been a roller coaster, to be very honest. It's been from one emotions, you lose certain monies. Like we were just talking before the
Because I was just going to ask
we're
that,
just talking
I
before
was going to ask that when you said you lost that your school fees then, and you said you're from a military background, I wanted to ask how did your dad get to here and what did he do?
till date, maybe eventually he gets to watch this episode, that's when he would be aware.
He wasn't how
None of my family members were aware. At some point, my dad did cut me off, to be very honest. And today we're not really in that child relationship. We're not really in that good relationship because to him, I've always been stubborn, and I wouldn't define my life choices to be stubborn because I believe that I'm a man, and there are things where you want to rewrite history. His dad was from a military background. He's also in the military. My mom, her dad is in the military. So all my life has been around the barracks. And
So as you are now, nobody can step on your toes.
I don't think so. They believe now. They all believers believe now. So yeah, that's been the ride for me.
Wow, that's amazing. So back to the center of, in fact, what I intend for us to discuss today, you have already, drifted towards that area, which is risk management. Because I've come to ask lots of mentors and, in fact, a lot of people that have held spaces online, different people talking about how to become profitable in Forex. Most people always hammer on knowledge, this year knowledge, next year knowledge, this month knowledge. Yet we still have the high numbers of people, that are not profitable. And people don't really talk about risk management, right? And I find risk management, personally, I find risk management to be, in fact, as important, if not important than knowledge. Because you can have all the knowledge and not be profitable, but you might not have all the knowledge and have proper risk management and be profitable.
So in that first time.
In this episode, I want us to, really break things down to people. How do you approach risk management as a trader, and how does it, give you an edge in the market? Then practically, I want you to cite some basic examples and teach the listeners how to approach risk management, or how you approach risk management.
Amazing. Amazing. Thank God we're talking about this. To be honest, the reason why a lot of traders don't study risk management, you can't blame people. Back then in high school, in primary school, we detest mathematics, right? We don't like maths. We don't even anything that gets to do with calculation, we tend to like move away. Only the very few nerds and the freaks that would love those subjects, right? And it explains the human psychology. It explains the concept why risk management can't stick to a lot of people, because imagine all your life you've hated calculations, and only to come into an industry where it's a must, right? You must calculate everything, the risk before the trade, the take profit before the trade. These things are very important. And one thing I've said is risk management is a universal law. It's something that stays constant. It's not modified or can be modified. It could be personalized, right? But then it's a universal law. For example, risk management puts you in a better position where you are managing your risks. For example, what we're saying in essence is the word is risk management, right? And under it, we have risk to reward. It's not just risk management. There are subtopics under risk management. We have risk to reward, we have capital protection, we have equity evaluation. These things are very important. But bringing back to your question in terms of how traders can maybe start implementing risk management, it's very simple. See, you have to realize that it's a game of probability, right? You can't win. Irrespective of what system you trade, you wouldn't win all the time. A 99% win rate system would always have that one time where it takes a loss. But you wouldn't want that one loss to take back the profit. So what risk management does for you is, one, it brings in capital protection, right? In terms of capital protection, you need to ask yourself, if this trade goes against me, it's the what if scenarios, right? You're starting a business. What if I fail? You're going on a trip. What if I don't come back? I'm driving now. What if? So these are the what if scenarios in trading. So you're about to take that trade. Yes, you're hopeful. Yes, you're confident. Yes, you think that, price would go well, I would hit that take profit, good and fine. But then what if? That's what capital protection is. So now you're saying to yourself, if I take this trade, if the what if comes in and it doesn't buy, maybe you're about to buy gold and it wouldn't buy, what if? How much would you lose?
Sure.
This is the conversation we need to ask ourselves. And it's called the pre-checklist before the trade. And these have to predefine, the maximum number of trades you're likely to take for the day.
Yeah.
At what point would you hit the panic button? When should you walk away from your chart every single day? The maximum trades a week, the allocated risks per trade. These things need to be defined before the week begins.
It's a serious business.
It's a serious business. Oftentimes people don't realize it, and you can't blame them, because even some mentors don't understand the need for risk management. Risk management is what brings in sustainability. It's what brings in, I keep telling people that there's a difference between being profitable and being consistently profitable. Anyone can. My grandmother can be profitable. She can come in, place a trade, and it gold is buying, it pulls. She's profitable. She made money. It's profitable, right? So, but then being consistently profitable, that's where you need risk management. Technical analysis can make you profitable. Fundamentals can make you profitable. Sentimental analysis, they will make you profitable. But then being consistently profitable, that's where you need risk management. So second, back to what I was saying, what we're talking about now is the capital protection. You need to ask yourself the what if scenarios. If price goes against me, what would I lose? So having this predefined subconsciously takes out the certain emotional impact.
Yeah.
I know that if this trade goes against me, I'll lose $500. I am pre-informed. The only time where it will upset me is when that trade goes against me and I lose $10,000.
Yeah.
That's when I begin to feel like, oh, what's happening? They've manipulated the market. But then if it goes against me and I lose, $500, I would feel bad.
That means what
But
you have
then,
to lose
exactly,
predetermined. You
Prede-
should know. So
predetermined,
you won't
exactly.
even know when price is
Exactly.
like going deep into your
That's
zone.
the concept of
Yeah.
risk management. So when you're done with the capital protection, then we need to go into the profit margin, right? This is where the reward comes in. Now we're dealing with risk to reward. The risk is capital protection. The profit margin is the reward. Now the reward now is one of the beautiful things about trading. If we're being very honest, trading is one of the crafts where you can decide how much you want to be paid if a decision is right. So if I want to buy gold now and I end up being right, I could decide how much I want to be paid. These are scenarios where we both could take the same trade, but then at the end of it, we have different profits. So the profit margin have to be predefined as well. You need to ask yourself, would I go for 1 to 5, 1 to 1? Now by 1 to 1, for those that are beginner traders, what we mean is, if you reach $100, you get $100 in return. If you're going for 1 to 2, if you reach $100, you're getting 200. So you need to make these decisions before you step into the market. And when you've done this, which means you've defined your risk, you've defined your reward. Now you have what we call the risk to reward, right? Now once you've done this, there is another thing you need to do, which is also very important, right? What is the maximum account exposure per day? This is very important. You can't just keep trading every single day. Yes, it's a 24 hours market. We understand this, but you can't be in the market every single time. So we need to ask ourselves, when should we walk away? If you're a day trader, if you're a swing trader, it's an entirely different ballgame. But then if you're a day trader, when should we walk away? For some traders, they will tell you, oh, they take just 2 trades a day. Some will tell you 1 trade a day. Others will say 4 trades. And these things are personalized. This is why I don't believe where because Mr. Peak is taking 1 trade every day, I will start taking more trade. It comes down to your system.
Personal
Exactly.
experience.
Would your system give you 1 win? Those things are very important. So in summary, risk management is very important. The maximum exposure per day is really important. If you have X amount of money and you need to, now this is what I do personally. You asked about the calculation. Now, if I have X amount of money, say I have $1,000, for example, right? What I do is I divide the $1,000 by the number of days I am comfortable losing the account.
Okay.
I don't know if that makes sense. So there are times where I
You are
have
comfortable losing
the account.
You are
Yes,
planned for the worst.
exactly.
So even when the worst happens,
Exactly.
it won't affect.
So I know for example, now I could pick a certain account. Let's say I have a $10,000 trading account, right? I could say, okay, this $10,000, I want to go aggressive in 5 days. I want if I lose for 5 days, then this account is well. So what I do is I divide the $10,000 divide by 5. The 5 trading days in a week. So we have $10,000 divided by 5 is $2,000 per day. So now when you have that $2,000, now you know that, okay, mentally it's $2,000 every single day for 5 days in a row to lose this account. Now, the question now is make sure you're certain before you make the decision, make sure you have data. I think we need to talk about back testing as well. Make sure you have data because you can't just make this decision based off assumption. The problem we have in the trading industry is the fact that most traders are assuming traders. They assume they have 70% win rate. They assume they have 90% win rate. But then when you ask them, I'm a Christian, I'm sorry if you're not, no offense to your religion, right? But then when God asked Adam, I think, why are you why are you naked or something? I can't reference the question. Then he answered with something entirely different, right? So it's
Said, "I'm
something.
naked."
I am naked, exactly. So what I'm saying in essence is traders are assuming people. You meet them and you're maybe mentoring someone, and from experience I've seen them. You're talking to someone and you're trying to get into their head to know where you can help, right? And then you're asking questions like, so the strategy you were trading, what was the win rate? And they tell you, oh, I have a 60% win rate. You have a 60% win rate. You shouldn't be paying for mentorship. You shouldn't. To be very honest, if you have a 60% win rate, you shouldn't be paying for mentorship. In the trading industry, 50% win rate with a 1 to 2 is fine. With a 1 to 1 is break even, right? A 60% with a 1 to 1 is profitable. So why would you tell me you have a 60% win that you're not profitable? So when I ask that question, traders are always quick to give a number. They will tell you, oh, I have 80%. But the following question is, how did you know? Right? This is the most trickiest part. I'm always quick to ask you, how did you know? Because we can't just assume you have 90%. You can't just walk into this room and tell me you are a citizen of China. There have to be something, a proof. So this is where data comes in. Traders who don't have data are the ones who often lose for the longest. So what I started doing is I started advocating for back testing online. To be honest, sorry I diverted a bit, but this is very important because when you're dividing the number of days to your trading accounts, you must make sure that you've tested your system to know that you can't have consecutive losses for that period of time. I don't know if that makes sense. So, sorry, let me take a breather. Now, what I'm saying in essence is traders assume a lot. But when you ask them, how did you know? Most of them don't have data to prove. So, what I'm saying to you is if you're listening to this episode, the best thing you want to do for yourself is get data. Don't be an assuming trader. Don't be that guy that sits down and tell people, oh, I have a 70% win rate, and you boast of your ignorance. Because a lot of time, these guys are really ignorant. So you need to, if you tell me you have 70% win rate, bring data, bring forth your strong reasons, right? And when you're bringing this data, to be honest, 100 trade is not enough. 100 trade is the starting phase. Now, I made a mistake. I said 100 trade. 100 days, not 100 trade, because there are people whose system could give them 10 trades in a day. And then they'll tell you, oh, I've had like real life first-hand experience with this. I mentor a lot of people, and you tell them, go back test your system and bring data. When they come back, you see in their records, in one day, they took about 6 setups. And then they accumulate all of those and tell you it's 100 trades.
Wow.
But that's not enough. Because if you take 10 setups in a day, it means that in less than 20 days, you would have hit 100 trades there. But that's not enough. The reason why we say 100 days is because that would have taken you through at least 3 months of data. Now you've seen that, okay, your system performed at least, we're using the word at least because 100 days is the starting point. We're looking over annual data. We're looking over, I've seen people that are obsessed that go all the way to decades data. They go over to 10 years data because you need data. Data are what gives confidence. What most traders see as psychological issue. Oh, I'm afraid to take a trade. You're not afraid to take a trade. You're afraid because you don't know the system.
Yeah.
It's different when you walk in here and I call you Samuel. Your name is not Samuel. You have data, you have documents to prove that your name is not Samuel. I don't know if you understand. So you wouldn't even be afraid when you're walking on the road and someone calls you Samuel. You wouldn't turn. So it's the same thing with trading. You are afraid because there is no data that gives you confidence. You can't be afraid if you've tested 1,000 days on a system. That room would not be there. You are sitting as an informed businessman. You know your product. You know that, oh, yes, I would lose for 3 days, but I would not panic because I know I have 1,000 days later and I've seen. So settling back to the actual conversation, because backtesting is a whole different sector on its own. Settling back to dividing your account days. This is why it's important to have the data. So what I do is if I have the $10,000, for example, I would divide it by the number of days you know um I am willing to lose, right? So if I divide by 5, I have $2,000 per day. Now, the second thing you need to do is now pick the $2,000 and divide it by the number of trades you want to take a day. It's a 24 hours market, but you don't have to trade every single time. So what you need to do is pick the number of trades you want to take. And again, don't pick this out of emotions. See, there's a lot about trading that is really not spoken about enough. People will go for 1 to 5 because the next guy is going for 1 to 5. They are sitting on a time bomb. To be honest, you have to go for 1 to 5 because you have data.
Yeah.
I don't feel exactly. Your system, there are systems that don't have the capacity to give you 1 to 5 consistently. To be honest, there are systems that are defined for, scalping. There are systems
1 to 1.
1 to 1. There are systems that are defined for swing trading. So if you picking the system you have, and then because Mr. Pick is going for 1 to 5, oh, his chart looks nice. Me too, I'll just draw it up. You understand? But that's the problem. And then this is where if I don't sit in a room where traders are telling you, oh, 1 to 5 doesn't work. 1 to 5 doesn't work. It doesn't work for you because you attempted to do it without data.
Yeah.
So all I'm saying in essence is when you are doing this, the number of trades to take in the day has to come from a point of data. That's where it has to come from. You need to ask yourself that, okay, I've backtested my system. Every time I backtest my system, now under backtesting, there's a thing called pattern consistency, right? When you're backtesting, you get to see that, okay, your system performs better around London session. I don't know if you've heard when people tell you, oh, I don't trade Asian session, or my system only prints in New York session. These are pattern consistencies, right? So you're looking for pattern consistency. So now you're saying that, okay, from backtesting, I've seen that I could have 2 setups a day. So why don't I focus on 2 trades a day, right? So, or you've seen that you could see 4 setups a day. Why don't you focus on 4 setups a day? Now, this is where you now divide the $2,000 divide by the number of trades you're likely to take. Now, when you've done this, then of course you have your risks defined, you have your capital protection defined. Now you have to define the profits, right? We need to keep ourselves in a scenario that come what may, few wins should cover up the losses you've had. So for me, it's always a universal concept. You have to divide the total equity divided by the number of days you're willing to let the equity go. And then when you've done this, you divide the daily the daily amounts divided by the number of trades you're likely to take for the day. Now, when you've done all of this, this is where repetition and consistency comes in. Don't be that guy that easily tweaks systems, right? Because you are taking certain losses, you begin to reduce take profit, or you begin to increase take profit, or because you're in a drawdown, you're cutting down. You see, I don't know. There are lots of ways to trade in the market. I don't want to contradict anyone, but then I don't believe in the idea that when I'm in drawdown, I reduce my risks. I don't. The reason is because I have a predefined plan.
Yeah.
The moment I begin to reduce my risk because I'm in drawdown, it affects my capacity to come back. So I always stick to the same rates because I know mentally that these decisions I've made, they weren't just assumed, they were out of data. So if it would take me 5 days to lose an account, I'm okay with it. If I'm in drawdown, I'll keep doing the same things in the same.
And if you go in, so be it.
So say you might want to the next one. So yeah.
Now you're talking about you talked about some things when you were talking about the risk management. First, you made mention of the calculating your risk before engaging the trade. Second, you talked about the profit margin, which gives you your risk to reward. Yeah. And the other one you talked about, knowing the amount, the capital you want to risk or the money that you want to risk per day and all. Now, in a situation where a trader, sometimes you can be on a losing streak, and some other time you can be on a winning streak. Now, for the losing streak, the fact that you have certain amount you have decided to risk for that day, it means you know when you go out of the market, where if it doesn't go well. Now, in a situation where you just keep hitting profits, at what point should you stop trading, or should you just keep trading that day? Let's say maybe you decided in your mind that, okay, I want to take 3 trades today. You took 1, it went well. Took 2, it went well. Took 3, it went well. You saw 4, 5, you took it went well. And that thing alone can, I've seen it. It has affected me before. When I was still an amateur, and like I was just on a serious winning streak, and I'm like, for me to be on a serious winning streak, in fact, I had to increase my risk. Yeah, like, let me just, I think, all in my head today, and I lost more than $3,000 in one single trade. So when should a trader, even if you're on a losing streak, stop trading for that particular day? Did you get my question?
Yeah, I get your question. We've all been there. These are experiences where you've experienced as well. So the thing is, to be very honest, I think everything comes down to the trading plan. And Mr. Pete, to be very honest with you, right? Risk management can't be discussed without back testing. Yeah. It wouldn't make sense. If we really want to have an effective conversation on risk management, we have to talk about back testing because the decisions that are made under risk management are as a result of the tested data. You can't make these decisions off assumptions, right? Now, I started with that to say something. When you are in a winning streak, the question of when should you walk away should come from the data you have. These are times where you have seen that over time, I've tested my system and maybe you go for a 1-2. Now, let me explain a scenario for everybody to understand. Now, there is a system I trade. I go for 1-5. I take a maximum of 3 trades a day, a maximum of 3 trades because of the data I've seen. Now, this means that if I take my first trade for the day and I win, I walk away. Now I have 1-5. But then if I take 3 trades and I lose 3 of them, I walk away. So which means if I take the first and I win, I walk away. If I take the first and I lose, I'll take the second. If I take the second, I win, I walk away. But if I take up to 3, I lose, I walk away. Now, this decision could be made based off the data we have. So what I'm saying is risk management in essence is it's a byproduct of the tested data. It comes from the decisions that are observed or the data that are observed from back testing. And this is why we cannot leave back testing out for the conversation, right? So when you're back testing this thing, if you're in this mess or you're in this space, if you're back testing, the one thing you want to do for yourself is make sure that you have data enough. Make sure you have data enough, and when you're back testing, look out for all those things. This problem you mentioned comes from pattern consistencies, right? Observe things. If your system is, and I tell people that if you're back testing, you don't assume risk to reward, right? Don't just go for 1-5 when you're back testing. Back test a single pair, for example, and let's say back test for 1-1, 1-2, 1-3, 1-4, and 1-5. Then pick the best risk to reward that perfectly outline or relates to the system. I don't know if that makes sense. So when you've done all of this, you will get to see these things would be answered from the risk management plan. But then if we want to say things to fan some people's ego, all we'll say is if you take a win and you feel like you're good, walk away. right? Walk away. But make sure that the winners are big enough to cover the losses, right? Your losses shouldn't just, one loss should not take out 10 wins. That's not how to trade, except if your risk reward is 1 to 11.
Yeah.
Right. So one win should not take out 12 wins, except your risk reward is 1 to 13. So these things are very important, that you maintain a consistency and a pattern in how you trade.
Now, still talking about the risk management, there are different capacity of traders in the forex space. There are people that have access to good capital.
Yeah.
Because one thing about that I know about risk management is that if you have a good capital, you can properly apply risk management. Okay, make little, but that little becomes much because of the capital. Now, let's say you have $100,000, just like maybe people trade prop firm that, oh, you reach 0.5% per trade and all. If you make 5% of 100K as profits, 5% seems small, it's small, big or 5%, but because you are trading 100K, that's $5,000 profit. If you take your maybe profit share of 90%, you are in good money.
Yeah.
But if you take that system of trading and come and trade it on $100 account, yeah, that means you're making 5% a month. How will that person feed? I mean, is it that there is no hope for those that are trading small capital? So I want us to talk about, the different capacity of traders, those that have access to small funds. I'm talking about between $100 to $1,000, and those that have access to big funds, let's say from $20,000 to maybe $100 or $1 million. Now, what method of risk management should these small capacity traders use that can at least make them some money at the end of the month? And I don't know what to say about the big, because the big ones, of course, obviously. So what's your take on these two capacities of traders and how they can effectively use risk management to make good profits?
So amazing. It's actually a brilliant question, to be honest, because we can't talk risk management and leave capital out of it. So to be honest, right, because while I was talking, I talked about the idea that these institutions make 10% a month. Now, this 10%, as little as 10% could sound, that is millions of dollars, billions of dollars, you understand? So we need to be very honest. Capital is important. And, there's a popular saying amongst traders where they say things like, if you can't manage a small account, you can't manage a big account. Now, this thing does have it's a two-edged sword, right? Because at the end of the day, you could be trading a smaller account and then not appreciate a system. And that's what you just said, which I said is amazing, because 5% on let's say 100K account is $5,000. The same 5% on $100 is $5. So you can't leave off 5% if you're trading a $100 trading account. So this is where the problem comes in. See, I would be very honest. Trading is a business where funding is important. To be very honest, funding is highly important. If your mentor is telling you, oh, do it with $10, do it with $20, it's not that it's not impossible. It's not possible, right? It's possible. Definitely, if you have a smaller account, it could scale into bigger accounts. But you see, the question is, what are the odds? What the success rates of people who take $100 to $10,000? How often does it occur? It's like the probability of that happening. It's like walking on the street and picking money, a bag of money, right? We won't rule it as impossible. We've seen in the news where we have people who maybe flight attendants, they see people's phones, bag of money in the airport, at the return. We've seen people where they say they pick a bag of money somewhere. So it happens, right? But then what are the odds of it happening all the time? And that's the same thing with smaller accounts. You would see one person's story that said, oh, it's $100 to it. You understand? And you're excited, but is it really how it works, right? So what I'm saying in essence is, we need funding, to be very honest. We really need funding. We need funding. If you're a trader, you need funding. I'm not saying go out there and take funds from people. But again, if you're confident,
Trading can really stressful with
it's stressful. You have to trade every single day. You have to hold trades. There are times where you have, like, let's say a $200,000 account. You just hold 1-to-1 and cash out good money, and you're done for the week. Exactly, because this is where we need to understand that mental stress comes in when you go trading the smaller account.
Yeah.
And we can't overemphasize the need for sufficient capital. Trading is like every other business. I've said this all the time. You see, if you're starting a restaurant business, for example, if we both want to start the same business with the same idea, if you're starting with $1 million in funding and I'm starting with $10,000 in funding, the same business idea, but then the way you will scale growth will be different. You can hire influencers, you can use billboards, you can use media outlets for promotion and adverts, but I can't.
The success probability will be high.
Exactly. Yours will be high. The only thing that might make you fail might now come down to other external factors. But then in the grand scheme of things, you have a higher tendency to success. So that's the same thing to trading. You could be struggling now. A lot of traders have amazing systems. To be honest, if you want to find profitable systems, talk to beginners. To be honest, most of these guys have someone within my team. I'm not going to lie. There's someone within my team. I got to realize that while he was just talking about his system, I was observing and I was picking some things from the system. To me, it just feel like, oh,
Same thing with someone in my tree. There is this guy, I used to call him that. I used to tell him that he's my mentee. That why do you used to trade poor man trading? This guy trades all these $10, $20, and he targets all these 7 and 10 hour. And before you know it, he has taken like maybe $10 to $70, withdraw $50, go to cook stew and everything. And I'm like, if you really big account on this, yeah, you do well. For real. I said that if you want to find good systems, talk to beginners, talk to people with smaller accounts. Those people have systems that are very good. Yeah. Because if you have a bigger account, Mr. Peak, let's be honest, you've handled bigger accounts. If you have bigger accounts, I've handled accounts up to 100K, 200K, right? Sometimes where this risk to reward thing doesn't even necessarily apply. You see one good setup yourself. You just need to reflect.
You just put like $5,000 on top and cash out 10K and you're done. You understand? But then the guy with the smaller account will be double checking. So if I put $2 on this account, I'll make just $3. I can't. So it's just the end product, right? Funding to traders is much needed. We need to be very honest with ourselves. It's much needed. If you're starting as a trader, your aim should be saving while you're learning, right? Saving while you're learning, saving while you're learning. I wouldn't advise you to, of course, go immediately and get funds from people. But why I wouldn't advise you, there are people that have done it and have success. Life is not someone's knowing the wrong way, and some are better in prison too. You understand? So the thing is, life happens, right? But the general rule is trading needs funding. It needs funding. This was the idea why prop firms came into the whole picture thing. But then we can see how the prop firms are becoming almost difficult to pass. So what I would say is, if you are in that space, you have a system, you don't have funding, look for an external job, right? Look for a side hustle, be saving, and make sure you save to a decent amount. An amount where 5% could mean something to you in a month. That is how I weigh funding for my traders. There are times where someone will meet me and ask me, oh, how much do you think I should fund that will be enough? I'll tell them, see, an account where you feel 5% is decent enough to be okay with, because the aim shouldn't be to make 1,000,000% in the month. The aim should be to make 5 to 10% in the month, which is achievable. Really achievable. So if you can find an account size where 5% is decent, then you're good to go. That way, if you make 8%, you're above your expectation. If you make 10%, you're above your expectation. It's all about the concept in business where they tell you, under promise to over deliver, if that makes sense. So this is just all I have to say. Funding is a must, and good funding is needed.
It's very needed. All right, that's very amazing. Then also, there is a way social media actually influence how people trade with respect to still the risk management that we're talking about. Because you come online and you see, one very respected mentor placing or maybe flipping, taking $1,000 to $10,000, or taking $10,000, risking all of their accounts. A lot of people do that. They just tell you they funded 2K and they are going all in, and they flip it. Now, sometimes some of those accounts go, which necessarily don't affect them, right? But most of the time, it goes in their direction. And some of these newbies will just feel that, okay, if this mentor can actually do this, that means I can really, flip this my $200 and all. Now, what effects do you think social media is having on risk management that is affecting traders generally, from your point of view?
Yeah, social media's perspective, to be honest, is it's crazy. It's crazy because even outside trading industry, there are certain influencers like comedians that I see online. I feel like these people are rich based on the perception I have of them online. And then you meet them physically, you get to find out that there are about 20 of them renting a two-bedroom apartment, about 30 of them. So you see how social media could paint a false narrative. Now, in the trading industry, right, there are people who do these things. Some could have it as a clickbait, because maybe you want to sell a course, and it's not wrong. To be honest, it's not wrong. In this our world, if you have to fake it to make it. Even in the business world, that's why we have branding, right? That's why we have brand perception, right? You have to fake it to make it. People need to believe what you want them to know you about, right? So if you see traders that are constantly, they fund huge accounts and then they trade it and they pass it, good and fine. But if you are Spartan, what you need to realize is these things, life is a process. Life is a process. In life, you must learn to walk before you run. You must learn to run before you fly. These things don't happen at the beginning stage. Right. There are professionals now. For example, I've met someone that is a professional chess player. Right. This guy is so good. But then they all had day one. They all had beginning stage, right? This guy could predict about 2, 3 moves ahead. But when he started, it wasn't that way. So what I'm saying in essence is you need to realize that while those people are doing those things, be happy for them, be motivated for them, be inspired by them. But then don't let what they do there influence you that you're here. You can't use someone's year 10 to compare your year 1. It's a suicide mission here, to be honest. So while you're here and you're looking at that mentor that is trading $1 million account, they're flipping this, they're flipping that, they're buying this, they're on vacation, be inspired. One of the things I do is within my space, I'm always happy for everybody. I'm always inspired by everybody. I meet people and I'm like, yo, I want to meet you. I want to ask questions. If I meet certain big guys in the industry, I'm always asking questions because to me, I'm inspired. I want to get there. But in as much as I aspire to be at certain places, I can't let those aspirations in my blend position me in now. So you need to celebrate the gari you're drinking today. Celebrate the white rice you're eating today. Celebrate the Nigeria you're in today, because tomorrow everything changes, right? So it's the building process. All I'm just going to say is people don't wake up and start flying. People wake up, you give birth to a newborn child, they learn to crawl, they learn to stand, they fall, they stand, they fall, they take first step. That's how trading is. So while you're looking at that guy, while you're looking at that mentor, doing all those flips, try to not get distracted. But again, these things are clickbaits, so let's be smart.
Now, with respect to what we talked about, talking about traders that don't have some financial capacity, yeah, and over the last few years, proprietary firm, they've been so dominant in the industry, and lots are coming up. So let me say in quotes, filling that gap or providing capital for people. Yet, people still do not do well trading prop firm. What do you think is the issue with performing well trading prop firm? Because some people feel that they have a system and capital is their problem, and they get access to a prop firm, yet they have been on it for like 1 year. They've not even entered, the funding phase. What do you think, or how do you think people trade prop firm that they are not meant to, and is making them not still make it in prop firm? Since we say capital is a problem and people are providing capital, yet we are still having data or people not, passing it.
Now, in all sincerity, and as one who literally have lots of prop accounts and funded with prop firms, I will tell you that in today's world, in the modern day prop firm, it's more difficult to pass a prop firm than trade a personal account. To be honest, because you have the rules, and now prop firms will tell you not to trade certain news events 5 minutes before news. So now you have to be aware of every high impact news, all of these things. So these things would tend to always affect you, to be very honest. So I wouldn't blame the trader per se, because prop firm trading it requires a whole different kind of thinking, to be honest. Prop firm trading, you can't trade personal funds the way you trade prop firms. I've met bigger mentors that would tell me, oh, the reason they don't trade prop firm because anytime they buy prop firm, they lose it. But then they trade their personal accounts and they keep growing. Yes, these things are real life things. I've seen like very popular guys in the industry and they tell me these things, and it's normal. Yes, I believe them and I understand, because you see, prop firm requires a different kind of ideology. It requires a different kind of thinking for you to trade. Now with prop firms, you need to be very intentional. Right, you need to be very intentional. You need two things, right? To be intentional, and you need specificity. Now, by specificity, what we mean is you need to be specific with everything you do. Prop firms can't be traded randomly, right? You need to be specific. The risks on every trade, the take profit level. You need to define, have information on the littlest thing. Will you be holding to take profit, or you'll be closing partials? If you close partial, what would this impact do to your account, right? On the days where you close partial and price moves in your profits, what happens to the overall PNL, right? These things are questions that most traders don't understand, because this is where I don't tell people that closing partial. I tell them closing partial is not nice, to be honest, especially with prop firms, because when you start modifying partials out, the losses, you don't close partial losses.
Yeah.
So why don't you exactly, you take full losses, but then your profit you want to take partial? That's wrong, because you're affecting the overall PNL. So to passing prop firm, to me, all I've said is, you need to be specific. You need to be very specific. Have one pattern or one model that you're trading. Trade fewer pairs. The success rate to profitable trading that I've seen around prop firms are those who trade fewer pairs, right? And when you do this, make sure that when you are, in a drawdown, there are a lot of things that happen around prop firm. To be honest, when I'm in a drawdown, I don't cut down my risks. I stay consistent. I stay consistent. But prop firms today are becoming extremely difficult, to be honest. So when we say prop firms are meant to bridge the gap between inadequate funding to adequate funding, but what we're saying now is, like, most prop firms don't want you to even be successful. They have systems that are designed for them. Of course, from the business perspective, they have to protect themselves. But when you are seeking over safety and then you're disregarding your end users' need, that you will create an environment where it becomes almost impossible to breathe for these traders, then you take away their gift, right? So prop firm trading is amazing. I always tell my traders, if you have $100, get a prop account. But when you get a prop account, the problem with most traders is they come in with the perspective of live account to prop trading, which means they want to make this money instantly. They want to pass this account almost immediately. Take your time. There's a reason why 2 years ago, prop firms would tell you, 2 to 3 years ago, the prop firms we had there would tell you that you have to pass your challenge in 30 days.
Yeah.
Yes, because they want you, if you don't pass it, then the account is gone. Then we started seeing newer firms reintroducing a new idea where they say it's unlimited, right? Now that you have unlimited, take your time. Imagine if you have a 100K account and you use 2 months to pass phase one, or even 3 months to pass phase one. It's fair. To be honest, use 3 months to pass phase one, which means on a 100K account now, let's say you're aiming for 10%. You divide which is $10,000. To divide that by 3, which means we have around $3,500. So you're averaging $3,500 every month. Now, what most people don't see is, if you could do that every month, imagine what you would do when this account is yours. You understand? So take your time. Use that 2 months, use that 3 months to pass your phase one. Use another period of time to pass phase two. You have 12 months in a year. Now, when you finally have your funded account, there's a thing called, reinvesting into your business, right? This is what I do all the time. If I get a payout, by the end of the month, I have analyzed all my payouts and I'd be like, okay, how much do I need to reinvest into my business, right? Get more accounts. So these are how to scale. You have 100K. Now you're life funded. Now you're trading. You need to scale. You need to go for the next milestone. So, in summary, what I'm saying in essence is, you need to think long term with prop firm. Think extremely long term. Don't rush the process. You have time. The thing is, you have time. Don't look at those people that are passing, proper accounts in 2 days, in 1 days. They do these things out of abundance, right? For me now, I could pick an account. I think I bought a 50K account recently from FN, and then I bought this account and I went full margin. I've been going full margin on it, right? Full margin. It's a 50K. I go 1K, 1K risk on a trade. You understand? Why am I doing this? Because I have something to fall back on. But you, on the other hand, you don't. You don't. This is the only funds you have. You can't be risking being. You need to think that, okay, if I go out of business today, where will I fall back on? So these things are needed with problems.
All right. So right about now, we're going to be taking a break so we can catch our breaths. And I hope you guys have been, enjoying this episode so far. I'm talking about risk management and how you can implement it to make informed decisions in your trading. We'll be right back after the break. Don't go away.
Hey, what's good, guys? My name is DakeJr, and I'm live at the Forex Trading Straight Talk podcast with Mr. Peak. It's been an amazing one. I'm not gonna lie. This particular episode is a must watch, to be honest. So make sure you watch. Make sure you take as much note as possible, and enjoy your time while watching the video.
All right, ladies and gentlemen, welcome back to Forex Trading Straight Talk podcast. It has been an amazing episode so far, and right about now, we're going to be rounding up, okay, this episode. It has been very much an educational, episode, and I believe that you guys, learned a lot. So back to you, Dick. Thanks for actually coming today. All right, I really, really appreciate it, and I appreciate all the some of these things are things that people are meant to consult you and pay and learn, but yet we're giving it for the community for free, which is actually very nice. So we're going to be rounding off now, and I just want you to, with respect to risk management and all, I just want to give an advice to everyone in the trading community, whether a beginner, so intermediate or advanced, on how they can use their proper risk management to make good decisions in the market.
Thank you. While we were speaking, I said something that was important. Risk management is a product from data. And all I'm going to say is, if you're a trader, if you're someone that you're trying to, perfect your risk management, in order to do it, you need data. So you need data. Now, backtesting is difficult. It's extreme. This is why most people don't do it. But what I'm going to say is, I want you to dare yourself to do something you've never done before, right? Do something you've never done before. If you backtested 100 trade before, push for 5,000, right? Sorry, push for 500, right? 5,000 is the premium. So per year, put for 500, right? Push beyond something you've done. Now, the datas you're getting, they are not for me. What these datas will do is they would keep you informed, and that's what you need. So if you're listening to this podcast, if you're watching this video, what you need is data. Risk management is a byproduct of data. So you need to sit yourself down, get the data as much as possible. Backtest your 1 to 1, 1 to 2, 1 to 3, 1 to 4, 1 to 5. Don't pick a certain risk reward because your mentor is trading it. It wouldn't help you. So pick something you have data on. So tomorrow, when you tell someone you have 80% win rate, there is something to show that it's actually 80%. So I don't have much to say. Risk management is the backbone of trading. It's the foundation of everything. It's the foundation of everything. You learn about everything you want to learn, but you need risk management. That is what would hold you in the days where your system will perform, in the days where your system would perform. So that's just all I have to say. Backtest as much as you can.
Then is there anything to backtesting you may want to share to them? Because I won't be surprised if some people don't know how to backtest and they're hearing backtesting.
Yeah, backtesting is, like I said, a whole topic on its own, right? But when you're backtesting, there are sub regions under backtesting that you have to look out for. There is, the first thing, of course, is the win rate. Let's be very honest. If you pick a system, why spend time looking for patterns if it's not a profitable one?
Yeah.
Right. So the first thing you want to do is this system
How often does it play out?
exactly? So what you're doing now is you're picking 100 days as a test trial. 100 days, not trades, because the days will take you through 3 months of data. We have 20 to 22 months of trading months in a month, trading days in a month. So what you want to do is take your time, backtest 100 days. Now, when you've done this, you would now see the win rate of the system. Now, in terms of the win rate, it would vary. You wouldn't have a specific number, but there's an average number, right? Now, backtest 1 to 1, 1 to 2, 1 to 3, 1 to 4, and 1 to 5. When you've done this, pick the one that best apply to your system. So when you've done this, the next thing to do is what we call pattern consistency. Now, pattern consistency is looking out for patterns with this system that are consistent. For example, what time of the day does the system form? If it's a day trading system, does it form around Asian session? Does it form around London session? Look out for those key things. Now, when you've seen this, how many setups are you likely to get in a day and in a month? You see, all of these things would shape into the risk management plan.
Yeah.
So what you're doing is pattern consistency is really, really, really important. And for me, these are like the two segments or, back testing, because under pattern consistency, there are a lot of things you're looking for. The time of the day the system performs, how many setups you're likely to get in a day, in a month, and in a week. In a week and in a month, right? You're looking out for these patterns that are very, very consistent, and also you're looking for pairs where the system performs better on. So these are things, and I'm not a preacher of backtesting on multiple pairs. If you must create multiple pairs, you must backtest the same number of data on all the pairs, because each pair have its own way of moving, its own profitability, its own P&L. All these things are needed with individual pairs. So when you're backtesting, if you must trade multiple pairs, you can't join their data together. You need to make sure that you're backtesting them individually. So you now see which of the pair performs the most, and maybe you can then find the perfect pair.
Wow. Thank you so much for honoring my invitation. This is like a full training course on risk management, if you ask me, a full training course. And I admonish everybody to try to, watch and digest this. And thank you so much. Thank you so much. I really appreciate it. So, ladies and gentlemen, we've actually called to the end of this amazing episode. And I want you to try as much as possible to watch, rewatch, learn, jot, and ensure that you get maximum value from this episode. And don't forget to subscribe to our channel, turn on your notifications so that you can always get updates whenever I release them. And see you guys on the profitable side. Bye-bye.